Hey, what's up, homies? Time for another episode of your favorite podcast, the Homeys Real Estate Podcast. This is Anthony.
I'm Angel.
I'm a realtor.
I'm a lender.
And hopefully together we can give you a pretty good idea of what's happening in this crazy real estate market. We're going to go back to the basics for this one, right? So I want to address pre-approving for a loan and what the difference is between a pre-qualification and a pre-approval. So I have Angel with us. This is what he does for a living, so I'm going to hand it over to him. Angel, what is the difference between a pre-qualification and a pre-approval?
Yeah, so I'll be honest, a lot of lenders, they interchange that word, right? And I've probably been guilty of it a few times, but really a pre-qualification is just kind of like when you go on, let's say if you've ever been on Quicken Loans or Better Rate Mortgage or some of these online bankers, right? You just put in your information. My credit score is this much. I make this much money. I have this much debt. But none of it's actually viewed by a professional, right? It's just a computerized approval saying or qualification saying, based on what you said here today, you would qualify for this much, right? But it doesn't guarantee anything because nothing has actually been reviewed by an actual loan officer, right? And saying, okay, what you're saying on your income checks off what shows on your W-2s, what shows off on your pay stubs, right? Your credit score is showing off when we run your credit. You have the same FICO score. So a pre-qualification is just more, I would say, like it's kind of an estimate, right, of what you qualify for, but nothing concrete, nothing for sure. Whereas a pre-approval, kind of like I mentioned right now, we actually review those documents and we say, okay, we ran your credit, you have this credit score, you're making this much every year. These are your debts on your credit report. Based on that, you qualify for this much, and it's more of a legit number, right, or an accurate number of how much you do qualify for.
Absolutely, and one key point in all this is that they do run your credit. It's necessary in order to get that pre-approval. And that pre-approval letter, not the pre-qualification letter, the pre-approval letter is what realtors want when reviewing offers, because they're going to be like pre-qualified, but are they really able to purchase this home? And more than likely, they're going to move forward with someone that has the pre-approval letter or someone that has a DU, which, Angel, what is a DU for them?
So yeah, a DU is referred to, or just in general, the general term is automated underwriter. So basically, there's two of them. It's called a DU or an LP. Don't want to get too much into like the exacts of it, but the basic concept is we take your loan application, we run it through a software. All banks have the software. They run it through it, and if it approves it through the system, basically saying me as a loan officer, if I put everything correct in the loan application, then you should have no trouble once you're in escrow of getting your loan approved with the bank.
Absolutely. So again, pre-qualification, probably not going to get your offer accepted. Pre-approval, much better chance. Angel, let's go into what it takes to get pre-approved. So, one of the things is income. Can you elaborate on this?
Yeah, so I'll go over it first. Wage earners or W-2 earners, right? So these are people you guys are employed by a company. Every year you guys get your W-2s at the end of the year, right? So we're going to need 2 years of that, 2019 and 2020 for this year. And then obviously next year when you get your W-2s, we'll use those. And then we also need a month of your pay stubs, right? So your W-2s are going to let us have an idea of how much you've been making over the last 2 years. The bank wants to see there's consistency in that income. If there's a decline in income, we have to, we're going to ask you, what's that reason as to why your income's declined? And then as that happens, we're going to also review your pay stubs, seeing that your income is aligning with your past income as well, right? So we just want to see consistency from your income this year currently, and then your income for the last 2 years. If there's not a consistency, what's the reason behind that?
Absolutely. Okay.
And then, sorry, I didn't mean to cut you off. I almost forgot. I don't want to forget about you self-employed people, right? So self-employed, for you guys, you obviously don't have W-2s, or maybe some of you do pay yourselves out. Then we use that as well, your W-2s, if you pay yourself. But we look at your taxes, right? So rather you have a corporation, you have 1120s, or you have 1040s, your Schedule C's on your 1040s. We look at that. So over the 2 years, and we average it over 2 years. Or if your income has declined in the last year, then we just average it over that last year. So in 2020, if your income declined, we use your 2020 income, right? And key thing for you self-employed people, it's not your gross income. So a lot of times I ask self-employed people, how much do you make? They say, I make 150,000. But then really I look at their taxes and their net income's only like 40,000, right? We look at net income, and that's very critical. Obviously, the beauty of being a homeowner is, a business owner, is you get to write things off. But the unfortunate part is when you're purchasing a home, we can't go with that gross income, right? We have to use the net.
Yeah, thank you, Angel, for elaborating on that. I was going to ask you what the difference between self-employed and W-2 earner, so thank you for giving that explanation. The second thing that a lender is going to be looking at is proof of assets. So explain a little bit about this, Angel.
Yeah, so the bank's obviously going to want to know where's your money coming from, right? So there's several places you can get your money from, right? As far as your down payment. Main thing is it has to be seasoned in your bank account, right? That's the key thing. So you could have money from your bank account for the last 2 months, right? So the bank wants to see that your closing costs and your down payment have been in your bank account for the last 2 months. If you have a 401k or some other type of retirement plan that allows you to take out money, that is also an option. If you have stocks, if you have other type of mutual funds, anything like that you can liquidate, you can also use that as well, right? If you have a family member, maybe your mom or your dad, saying, hey, I'm going to pay your down payment, I'm going to pay your closing costs, they can do that as well. We just need 1 month of their bank statements, right? So there's pretty much any money that's a verifiable source we can use, right? As long as it's coming from somewhere that we can verify and prove that it's been seasoned there shouldn't be any issue using it.
Gotcha. So I think another important point is that this money does need to be liquid, right? Because we can have assets, we can own homes, we can own cars, right? They're technically assets because we own them outright. But you cannot just pull that money out and purchase, right? It has to be liquid at that point.
Yeah.
So that's something that's very, very important. And, the third thing lenders are looking for is good credit. Elaborate on this.
So it all depends on what lender right now, especially with COVID. Some of them changed what's required to what credit score is required to qualify, right? There's different programs. The general rule is most lenders are going to say 620, right? 620 credit score is what you're going to need for an FHA loan, right? So some lenders are going to allow up to as low as 580, but honestly, in my opinion, it doesn't make sense for you as a borrower to come in with having a credit score less than 620 just because interest rates aren't as good. That DU that we were speaking about is harder to get approved. Different. It's just a harder process, right? 620 and up, preferably over 640, 660 is even better. But 620, you're still getting a good interest rate. Should have no problem getting the approval from the system. So that's to get an FHA loan. And then credit. I always tell my clients credit's going to be good for two things, right? One's going to determine your interest rate, and two is going to determine what programs are available to you. So the higher your credit score, the more options are going to be available, right? So maybe you're looking at down payment assistance. They require a little bit higher credit scores. Conventional definitely going to be in the, I recommend the 700s, and then FHA. So now you have more options. Whereas if you're at 620, every lender is going to give you the FHA option because that's really the only one available to you.
Absolutely. So that's great to know. Remember, the two things are you'll have more options available, and then also it's going to impact what interest rate you get. So the next thing that lenders are looking at is employment verification. So what does this mean, Angel?
Yeah, so this is a big one, right? We need to see that you have steady income, right? Or that you have steady employment. Very important to the bank, as they want to make sure that you're getting the money back, right? So they're going to want to see a 2-year history of you making money in the same job or same field, right? That you have a 2-year history of working. Mm-hmm. So if you have that, then that's perfect. Then you'll have no problem qualifying. Is there a way around this 2-year history? Yes, there is. In some cases, and particularly is pretty much one case, right? It's if you have some type of degree. Doesn't have to be a bachelor's degree, master's degree. It just has to be a degree or a certificate in a specific field, and you can apply that to your job, right? So you can go to trade school. You can go to have a bachelor's degree, associate's degree, some type of degree that's going to pertain to the job you have now. If that's the case, you can use the income right away, because your history at a trade school, your history at a maybe at a community college or at a university, that counts as your work history, right? So that's the way you can get around that 2-year history. If you don't have that, then you are going to have to build a 2-year history in order to obtain a qualification.
Gotcha. Okay. Sounds good. That makes sense. So the last thing and the fifth and final thing that lenders are going to be looking at to get you pre-approved for a loan so you can make an offer on a home is going to be forms of documentation, right? Which forms of documentation are you going to be looking at?
Yeah, so it's like just identification, documentation. So your ID, your social security card. If you're here on you have a green card permanent residence, we're gonna need to see that. If you're here on DACA or work permit, we're gonna need to see your work permit. So just those documentations, just to basically, of course, verify your identity, and make sure that everything on the loan is actually you, in a sense, right? Make sure everything's correct on the loan.
Okay, awesome. Yep. Identification is really important in getting pre-approved for a loan. I can't argue that.
Yeah.
So, Angel, we kind of went over, what the difference between pre-qualification and pre-approval is, the 5 things that you need to get pre-approved for a loan. Now, what's one tip you want to give to somebody looking to get pre-approved?
Yeah, I hate saying it because I say it a lot, but it's just really, really important. It's going to save you a lot of time and potentially headaches right later down the road. You're gonna, you're probably, you're going to home, for example, you never talked to a lender, you've never been pre-qualified or pre-approved, let alone pre-qualified, right? Just the basics. You've never even done that, and you want to make an offer on the home, and by the time you want to make an offer, you still have to go through this whole process, which, depending on the lender, can take time. Some lenders are a little quicker. I try to get mine done within the day, within the next day, depending on what the schedule looks like, right? Or some lenders, especially if you go to like a big bank, they're going to take a few days a lot of times just to even get you an appointment and get everything reviewed. So by the time you have your pre-approval, that home can be an escrow, right? So it's very important to be pre-approved, not only because you might want to make an offer, but to even know if you can make an offer on that home, right? Because maybe you don't even qualify for that property. So you know exactly where you qualify for, what your monthly payment is, how much money you need to put down. All these are very important. And for anybody who's scared, it honestly isn't a scary process, right? So it doesn't hurt to come talk to somebody. To us, it's absolutely free. I'm pretty sure most people, it's not going to cost you a penny. So it doesn't hurt anybody. It doesn't hurt to go out there and talk to somebody and see how they could help you.
Absolutely. So I can't stress that enough. Try to get pre-qualified or pre-approved before you look at homes. Last thing you want to do is fall in love with the home, and then something comes up in your credit report, or for some reason you don't qualify, and you just wasted a tremendous amount of time, got your hopes up, and you're not able to make an offer on the home. So, Angel, that's a really great tip. Homies, I hope you enjoyed this podcast. Next week is a Halloween, so I'm excited for Halloween. I'm excited to bring this podcast to you. Again, this is Anthony.
I'm Angel.
Angel, where can we find you?
At Your Mortgage Angel on Instagram.
And take care, trick-or-treaters. Have a great day. Love you all.
Thank you.
Hey homies, it's Anthony. This podcast contains my opinions and is for educational purposes only. It does not guarantee any projections and should not serve as a basis for any purchase or sale in real estate.